This entire week will be about exclusively crypto, but we're zooming out to take a look at global markets and how macro events of this past year have impacted crypto markets. And this is a unique lineup too, because many of our speakers have experience across traditional finance and also traditional AI investing, which has been impacting a lot of the early stage and also liquid crypto deals that have been getting a lot of interest. And so I'm going to introduce our panelists, some new and old friends. Steve Lee began his career at Goldman Sachs, has enormous experience working across Asia and also the United States, spent 5 years at Block Tower, and recently formed and launched Neoclassic Capital in 2024. We'll be sharing some big news very soon about the fund. We also have Alan Du, who's a partner at PayPal Ventures. They launched PYUSD in 2023. And more recently have been engaging in the P2P payments space. And Alan will be sharing more about his interest in AI infra. We also have Kelvin Ko, who's the co-founder and CIO at Spartan. I've been fortunate enough to actually be a co-investor in some of their portcos, and also they were one of the first investors in Layer Zero, one of the projects that I've been very deeply involved in. Actually, PayPal Ventures is also one of the earliest investors. And then we also have Richard Galvin, who began his career at Goldman Sachs as well, many years at JP Morgan, and co-founder of DACM, which is one of the top performing public and private multi-strategy crypto firms. My name's Irene. After dropping out of school, I joined the early team at Layer Zero Labs, where I ended up leading strategy. I later joined Bain Capital's crypto fund as one of their venture partners, and I am now a solo angel investor across traditional AI and also decentralized finance infrastructure, both on liquid and private investments. So I want to kick off by talking about something that many of you guys maybe were thinking about this past week because it impacted your portfolios, which was the Fed interest rate cut. People were expecting that this would lead to a bump in prices because crypto is a risk asset, but we ended up seeing the opposite, particularly in quality assets like ETH, Bitcoin, Sol, but then also altcoins. And the only exception was XPL, which launched on the 25th, and we'll talk about that in a moment. But I'm curious to hear your guys' take on why that may have been. Was it because it was a sell the news type event? Was it already priced in? Was there too much leverage? Perhaps Kelvin and Richard, curious to hear your guys' take given how close you guys are to the market.
Yeah, I think the market clearly was already expecting a 25 basis point rate cut, right? And so I think that wasn't a surprise, right? There was obviously a small probability we ended up getting 50, but that didn't come. I think the equity markets rose a little bit, but crypto pretty much didn't react and then sold off. I think the sell-off had to do with, partly had to do with Mt. Gox sort of moving coins around. I think that was part of the reason. And then, of course, we also know that there's been a bit of changes in the DAT market as well. And we clearly haven't had as much DAT flows of late than before. And then the ETF flows also kind of mixed. So I think the combination of those things kind of affected how crypto and altcoins traded.
Yeah, I think the crypto market, although it's probably not enough to call it a trend yet, but it's been relatively good at front running and being the most kind of, I guess, the canary in the coal mine for a lot of moves, particularly at a macro level. And it had outperformed equities at a fair way into the interest rate cut. So it was pretty much giving back a bit of that outperformance. And then, I agree with Kelvin. We saw a bit of a slowing down in the premiums on the digital asset treasury companies in the US, which took a little bit of the sort of buying power out of the market, and a lot of traders have been sort of front running that demand, and as that sort of comes down with the premiums, the market got a little weaker.
Also, something that was astounding this past week was, of course, Plasma's token launch. I know some of you guys were watching that closely and even have engaged with the project. There's so much to admire about the way that they have launched, and then also the stablecoin narrative, you could call it, but also the utility and all of the momentum around innovation there has been really exciting to see. I was joking with a friend of mine yesterday. People were asking, well, describe the narrative around stablecoins. And I said, well, the narrative is revenue. And the actual utility there is generating revenue. And so I would love to hear more commentary from you guys around the XPL launch. There is a lot of inflows there. We saw a surge, some correction, but then also some more interest after that. And from each of your funds, how are you guys thinking about stablecoins?
Okay.
Perhaps Steve,
yeah.
given that you're just launched.
I think a lot of people talk about plasma, but rather than giving my unique view on plasma, because it's still new, I don't want to take a sort of definite view on things that just launched. But speaking of a stablecoin, I feel like I was in Korea last week. I met all the top 5 conglomerates and top 4 financial institutions. And compared to what I hear from institutions in the United States, where I base, definitely I think there are some institutional FOMO, I call it. So in this last 11 months, I see the market is a little bit bifurcated. So retail, somehow they got burned after meme coin AI agent, which is up to February. And I hear that many people lost a lot of money. So they still think that, bull market hasn't come. That's something that people always thinking, look at where is the upside now? I think we are already upside market if you look at the performance for last 11 months. But at the same time, those new comer of institutional investors, I met a lot of people in Korea, US, they want to do something with the stablecoin, but they just don't know what to do. So like a plasma is backed by some reputable names that easily get a lot of attention before their realistic kind of traction that hasn't been proved. So my point of view is there will be a lot of a stablecoin related token that will launch. But whether which stablecoin has competitive advantage is to be more answered. So for me, the most important thing for a stablecoin business to be get the major traction is whether they have a distribution channel. I personally think that the payment business is not about innovating new technology like a ZK solution or Bitcoin layer 2 or etc. It's more about whether you have ability to partner with the right distribution, whether if they don't have their own stuff. So we look at whenever we invested as a private investors or VC, whether the stablecoin related business people, whether they have ability to secure the distribution channel or partnership. That's a kind of key thing for us to look at stablecoin business when we making investments.
To the point of where we are in the cycle narratives are incredibly slippery, and this is a tale as old as time since early 2010s in talking about crypto. I have heard varying statements during this week, and I'm curious to hear from each of you from your conversations with your portfolio founders and also how you look at the market. Do you think that we are in an accumulation phase, an expansion phase, or a distribution phase right now? And what signals are you looking at to inform that perspective?
I can go. As I related to what I just said, at the moment, institutions are interested in digital asset treasury called the DAT, a public equity investing into crypto. And headline is all about regulation, stablecoin, pro-crypto regulation, etc., etc. So institutions are very interested in those things. But to Elaine's point, all the founders or entrepreneurs are a little bit kind of exhausted because they don't get the spotlights anymore. So to your point, I think it's a little bit tough market for entrepreneurs building very startup at the business. So I would call it as for private market, funny enough, I would say it's a little bit of accumulation phase. Even though public market, which is trading token market, is sort of a bull market at the moment. So whenever I meet our portfolio company, which I just had a lunch with, my advice is just don't get distracted by this public market news like a digital asset treasuries. I think there are moments will come because only thing I will mention here is Stablecoin Act will make this on-chain economy. Means that stablecoin will come onto more and more stablecoin will come onto blockchain. That means that people on chain, need to use that stablecoin to where? Are we gonna just keep doing yield farming for another 5 years? I hope it's not. Means that they might want to use a stablecoin into some consumer goods or consumer product on blockchain. So that's our recommendation for our portfolio company. They are building some product and service that people on chain gonna use their stablecoin into. It could be gaming, it could be entertainment, it could be payment, it could be entertainment or etc. So that's my advice to portfolio company: keep building what makes the people to use their stablecoin on chain into, rather than just trading. Trading is a big part, but to make this on chain economy much bigger, we needed something just other than trading.
I think the market's oddly split into kind of two universes at the moment. You've got the traditional crypto market, which has kind of been the champion of the entire asset class for the last 7 years. And I agree with Steve, there's probably a little bit of exhaustion, and you can get it given the volatility and the life you have to lead to be a crypto founder. And with the stablecoin kind of revolution and the ability to have a utility case that's readily explainable to a traditional finance, can get through traditional finance investment committees and those sorts of things, and it's really becoming kind of the spearhead into traditional finance. We're seeing a heap of excitement on the traditional finance side, much more than on the crypto native side, which is kind of an odd position because it's kind of flipped from where we are before. And I guess we're kind of seeing that particularly with the DAT phenomenon as well, where you're basically seeing flows from traditional finance buying from crypto people. So markets are good at balancing where liquidity is at that point in time, and it's chalk and cheese between the sentiment of the crypto native people, which I think need to make sure they don't lose sight of the bigger goal, versus traditional finance. I mean, you've got the Treasury Secretary of the US saying that within the next 5 years they want to 10x the supply of stable coins. I mean, you do not get growth like that in any other industry. So you can see why traditional finance hears that from someone in a position that senior, and it becomes the tech they want to invest in.
So I think a lot of what's happening or happened in the last 6 months has a lot to do with the success of Circle, right, and Ethena, right? So
Absolutely.
Circle obviously showed, I mean, the IPO itself, was not priced very richly. You got it at $31, but it went all the way up to $300, right, in a matter of weeks. So I think traditional investors, hadn't seen that kind of explosive growth literally since Microsoft maybe, right? So I think that really sort of captured a lot of attention. And on the crypto native side, obviously Ethena's growth has also been, really one of the more exciting stories of this cycle. And as a result of that, what we've seen over the last few months is we've seen a lot of new yield-bearing stablecoin projects. I mean, I must have seen like 50 deals in the last 3 months, right? So we're seeing a lot of that. We're not touching too many of them because I don't think it is as easy as it looks.
Yeah.
We did invest in Circle 2 years ago, and so we had our exposure there through one of our venture funds. We did invest in Plasma in the public round, and I think that trade was quite easy. That call was quite easy for us to make because we knew it was going to do well. The market at that point was thinking, look, this is invested by Tether. Tether's going to support them. Now most of Tether's volume is going on to Tron. Tron is a $30 billion player. We're investing in this thing at 500 million, right? So it's a no-brainer. We thought this would be a 3 to 5x investment over a couple of months. It ended up being a 20x investment, which is fantastic, right? So a lot of these themes are kind of interconnected.
I want to hear more about things that are more difficult than entrepreneurs think they are to build, but where there is actually a pull. So, Alan, we were speaking backstage around AI infra. You actually come from more of a traditional tech background, but you are personally passionate about crypto. And so you find yourself in this in-between area where you're drawn to entrepreneurs who see novelty in blockchain rails to build something. One of your investments is Kite AI. Could you speak a little bit about that and what makes what they're building actually quite challenging, but also a unique solution to maybe problems not just within the crypto industry?
Yeah, sure. I think it's an interesting point you brought up earlier, the issue of cycle, right? And we tend to think of ourselves, whether rightfully or wrongfully, as sort of a non-cyclical or counter-cyclical investor. Generally, we try not to follow the momentum. We try to go where people are not paying attention. Particularly within AI infra, it takes a long time to build something, right? And so generally, we like to be ahead of the curve. And on the topic of what Kite AI is building and why it appealed to me so much is that as we look at payment overall, right, we're not talking about just stablecoin-based payment, we're talking about traditional payments. We're really talking about identity. What does that mean? 20, 30 years ago, when you needed to buy something, the Labubu doll then, whatever that was, from Singapore or from China, and you're in the US, you didn't know that person didn't know you, and your banks don't know each other. How do you establish that trust so you can actually transact with that person on the other side of the globe? Well, there's a little company that popped up in Silicon Valley called PayPal that built this sort of global identity network. And as we look forward to this sort of new age where agents are becoming more of an empowered actor in the overall economic equation, and we're not just talking about agents that are, say, on Perplexity, on OpenAI, where you say, oh, go buy me a pair of Nike Air Jordans, right? And find the cheapest price and go make that transaction, which I don't know how many folks have tried, is the very much clunky experience, right? Agentic payment, agentic commerce right now is largely experimental. And the fundamental issue with that is right now, AI agents lack their own AI native identity infrastructure, right? And what do I mean by that? Right now, AI agents are borrowing identity from you, from the human user, right? They're called delegated credentials, either through a virtual card solution or network tokenization, all of which are based on real-world KYC human identities. That's fine to the extent that you're dealing with sort of a one-to-one type of relationship. When you're telling your PayPal agent or Perplexity to go buy something from Walmart, those are two systems of records that can talk to each other and know each other. But what happens when you go buy 10 different things from 10 different vendors? And what happens when your vendors are buying something else from their vendors, right? Particularly if I'm buying compute from, in the middle of Montana, I'm paying for model access in Sweden, I'm paying for data access in the Philippines, and the data vendor in the Philippines are buying access from Hong Kong. All of a sudden, you get into this multi-party, but needs to be real-time, needs to be KYC situation, where traditional identity it does not function across jurisdictional borders or institutional borders, right? And this is what makes Kite AI unique in that they're giving AI agents their AI native identity and allows the agents to actually accumulate what's the equivalent of a FICO score, right? For those not from the United States.
And how are they using blockchain?
The credit score, or the equivalent of the FICO score, is essentially written on chain. Right, so not everything needs to be on chain, particularly as you think about balancing performance versus accuracy versus safety versus everything else. That trade-off has always been a big block, right? So Kite, what really attracted me was that they were the first purpose-built L1 to enable agents to have not only their identity but also maintain sort of the track record, so that you actually can pick and trust what agents you're interacting with.
Thank you so much for that walkthrough. As Kelvin said, I do think that in the AI and crypto space, for me as an angel investor, I'm often looking for entrepreneurs who actually have a keen understanding of where blockchain has utility and where not to inject that. And one of the common misgivings is certainly prematurely launching a token. And I think, Steve, actually, when you were speaking about getting distracted with where we are in the cycle, some of my portcos asked me, well, we're in a bull cycle, or the bull portion of our cycle, and that must mean that I have to launch my token right now. I mean, I'm sure, Kelvin, you hear this quite a lot because you guys have, or you see portcos across a long cycle, given how Spartan is structured. And what I have been saying to them is actually you should be launching your token when you've earned the right to launch your token. And that often means when you're launching your token, you're essentially IPOing your company. It takes time. It really takes time. And you should have the maturity of your company at scale, which means quite literally the employees of your company being comfortable with having the price of your company oscillating every single day. It's often very disorienting to be able to see that. These are the small things that I think often entrepreneurs aren't thinking about. So considerations of cycle narratives, certainly.
Just to add one thing, I think I view slightly differently. For last 7 months, my observation in this crypto token launch is most of them are unsuccessful. So again, some outlier, but generally on TGE, token generation date event, even one of the most successful projects called the Pump That Fund has all this kind of the token holders, they got airdrop, they got free token about their uses before token. 70% of them are selling very hard. So my point here is when you token launch, the understanding market is important, but that means that who's going to buy your token. So you also have to understand this demand side is intact or not. So I think that's something that many entrepreneurs do not think about it. Okay, bull cycle, bull buy, I should launch, but who's going to buy your token? DAT is the same. If you launch it, who's going to buy that sort of one of the unknown altcoin DAT? Who's going to buy it? So people don't really much think about the buyer of the token. So that's another factor that I recommend our portfolio companies consider when to launch the tokens.
And to your point, founders have to be aware of the fact that their token is in itself a product. And for some companies or projects, it becomes their main product, which is a brutal reality. But it's you then, if you have a product, need to think about who the buyers are.
Right.
Well, I want to then... Oh, go ahead, Kelvin.
Yeah, I wanted to just add one point to Steve's comment. I think he makes a very good point about thinking about who your buyers are, right? Because once upon a time, I guess in prior years, as a crypto startup, you didn't need to have revenues, right? You just needed to launch your mainnet or launch your product, and then you launch a token, basically, right? And hope that you get on enough exchanges and you're able to sell the story or sell the dream, and people would buy it, right? I think the market's kind of a little bit tired of that narrative, and they're basically asking, okay, show me the revenues, right? And so over the last couple of months, if you look at the things that have done reasonably well or are able to maintain that kind of billion-dollar plus valuation, it's really been about projects that have either significant adoption and are generating fees from day one, or they're about projects like Pump.Fund or Hyperliquid, where they're making so much money and the majority of that cash flow is going to buying back tokens, right? And so that's the kind of story or narrative that markets focused on these days, right? So the revenue angle has become a lot more important than before.
Can I add one more point?
Please, go ahead.
I think related to Kevin's, I think a DAT also is very important. So to be digital assets treasury to be further, they have to find these sustainable revenue models. So I think that will be the challenge or distinguish the great DAT versus not. So which means that to the title of this panel, where's the upside now? One thing I'll pick for the DAT space will be if the DAT is legitimate and then they are considering about how to making a revenue, how to making a sustainable some profit out of the cash they raise through the pipe, the contract will be where they gonna deploy this cash into. So for example, BitMiner, successful ETH treasury. Some people say, some people not. But my thinking is always like this. So they raise up a lot of cash. Where do they gonna deploy their cash into? Ethereum ecosystem, then which projects? So that is, I think, one way to considering where's the next upside. So all the cash sitting on DAT, where would that cash going into if they're going into deploying to on-chain, which they are supposed to make some revenue, the DeFi yield, etc. So that's something that adding on to Kelvin's point, the making revenue sustainable, some real numbers is important.
Please go ahead.
Yeah. So what's really interesting is I think when it comes to upside, there's the upside coming from stablecoin replacing existing ways to pay for things or manage finances. But I think there's a potentially much larger pot of gold, if you will, when it comes to agentic commerce. What I mean by that is we pay for data the same way we pay for software 30 years ago. Perpetual license, you buy it once, you get to use it, you probably use 5% of it, and the data gets stale very quickly, right? And then something called SaaS happened 10, 15 years ago, and all of a sudden unlock all this liquidity, right? Liquidity from a product access, billing, and economic model standpoint. And I think there will be a point at which, and it's already beginning to happen, given that a few months ago, JP Morgan announced that you can no longer access our customers' data freely. You have to pay for it now, right? So all of a sudden, everybody's waking up to this fact that, you know, it's cliche to say data is new oil. It absolutely is, right? So the day of getting free oil from somebody is over. And there's an interesting thought experiment around, will software be free in the future as cost of compute comes down, cost of inferences come down, and with, you know, the lovables, the vibe codings of around the world, so to build a software to launch a feature, you can do it very cheaply and be able to scale it very cheaply, right? So if software were to become free, then what do you have to charge for? Right, it's probably domain expertise, probably domain-specific data, proprietary data of some sort, right? But how do you manage that data access and be able to actually meter the usage of that? Unlocking that through some kind of a streaming payment, micropayment model is something that traditional rails that are half a century old, over half a century old, simply cannot handle. Which is why I think some kind of a wallet-based plus, you know, blockchain-based solution for these micropayments is the only viable solution. And that could potentially unlock tens of trillions of economic value.
I completely agree. And I'm thrilled to hear this from the perspective of PayPal Ventures. And you guys have been looking at different complementary technologies for a really long time. So it's a strong point of view. I appreciate that. In this volatile macro environment, do you guys believe that there's more upside in liquid bets right now or venture bets? And I know for Richard, Kelvin, and yourself, Steve, you guys are the founders or co-founders of your own funds. So it's often at your own discretion if you want to allocate more on the liquid side or on the private side. At this stage right now, where do you think there's more upside?
I mean, we work across both with liquid fund and venture fund since 2018. I think the trend, and it partly goes to the discussion around launching tokens around VCs. I think the risk reward for VC has come back substantially given, you know, the time to list a token, the token performance, and I guess the underperformance in crypto of small caps. So, you know, the returns...
Meaning it's higher risk?
No, the returns have been coming down, and particularly the risk of getting to liquidity has been lengthening as well. So, I mean, you know, as an aside, we launched our fund as as an ICO fund, and, you know, there was a period there where you'd make an investment and we'd have liquidity within 2 weeks. And, you know, those days are long gone, right? And crypto's trending much more to what I'd say is a much more traditional venture market where, to your point, you've got to earn your stripes before you can launch and take on the new stakeholders that come with being a token. On the liquid side, we've probably seen, you know, substantial underperformance outside of kind of the mega caps, where there is a bunch of tokens that have pretty good prospects in our view that are trading at sort of, you know, sub 50 million type venture type valuations, and, you know, they've been in the wild for a long time. They've got teams that are used to managing the stakeholders. They've got users. They've got revenues, but they're struggling to get that attraction in a market that's very much focused on that high-end liquidity. So we have seen, I would say, a compression between where, you know, at a lot of points in time, our venture fund over the last 12 months has invested in liquid tokens because they've looked like better value than most of the venture deals we've seen.
First of all, I don't think it's right to compare the liquid fund and VC because it's very different risk return profile and very different investment period. So I think it's very hard to compare. However, in terms of opportunity, I'm not going to say VC has more upside, liquid has more upside, because if the macro turns so badly tomorrow, that means the liquid has more risk downside because VC just go to zero about cost. But so my point is, I think for now, considering this institutional little bit of FOMO-ish that into DAT, if that sustains, then I think for next 6 months, more opportunity in liquid fund. Yes, I would say so. However, the macro liquid fund, the other way is more sensitive to macro risk and then this macro uncertainty. Even compared to that, VC is, to be honest, less sensitive to the macro environment. It depends on when your project's going to be listed. So I would say liquid. I think if your investment period is 6 months or 3 months, kind of that short period of time, I would say liquid maybe has little more obvious opportunity return profile. However, if you are more long-term investors, I think a private market is also very, very attractive because the price gets lower, valuation gets lower because, as I mentioned, people care less about this private investing because all the FOMO and eyes and returns going into double-digit performance year to date for most of our top 20 assets. So I would say still as a VC investors, we see a lot of attractive opportunities because we can negotiate with the deals better because there are much less competition about investing to our early stage investing. So I still very bullish on private market opportunities, and we are not here to take a return 6 months from now, but we are more long-term investors. So that's why I see the private market is still very promising.
Yeah, so we have a couple of funds, right? We have a discretionary long-short hedge fund that invests only in tokens, and we have 2 early-stage venture fund. I would say that in terms of directional strategies, I'm probably not as bullish going out the next 12, 18 months, just because I think we're closer to the top of the cycle than the bottom. And so if you are invested in a directional fund, I would say you then have to rely on the skill of the manager, right, to be able to go short and make money in a bear market, which is generally not so easy, right? About on the liquid side, we are planning to very shortly launch a market-neutral fund.
Interesting.
That doesn't take a directional bet, and we can run the book in such a way where we can generate 20% returns on average with very, very little volatility. So I think that's a pretty good risk-reward over the coming 12, 18 months. And then on the venture side, we haven't been particularly active in the venture space just because I think the things that look interesting are all overpriced. And then there are other areas that look more interesting like AI agents and whatever, prediction markets. But some of those spaces, DeepIn included, are a little bit early. And I think the venture industry is also going through a bit of a shakeout, if you will. And I think the amount of funds that you see getting raised in this cycle will be dramatically less than the 2020-21 cycle. So what it means is that a lot of projects will not be able to get funding, and that is generally a good environment for VCs, right? Over the next couple of years, VCs will be able to get in at valuations that are much more attractive than what we saw in the 2020 to 22 cycle. And so I think on a 2 to 3 year time frame, I think we will start to get more active in VC investments again, but probably more into the latter half of 2026.
As we near the end of this panel, I have 2 more questions for this entire group. The first one is, this conference often brings together a lot of early stage founders or people who are thinking eventually about building something. And as we said, that often takes multiple years until you've earned the right to be at the place where perhaps your funds are ready to engage. I, as an angel investor, sometimes go out actually looking for founders that fit the profile of what I'm looking for, and then give them capital and tell them almost my wish list of what I really want to see built. Is there a wish list idea or you have a problem that you really want founders to be solving? A space, maybe get even more specific. And like you said, maybe it's not this year, but thinking 2, 3 years out, that's really our job, to be thinking many years out to share with the group here. That's my first question.
State of obvious. I think AI, using the AI agent well into blockchain. So it means that, as Irene mentioned, there are so many we are the AI projects deals that I've seen for the last 6 months, but none of them really understand why they have to do with the blockchain or why they have to do with the AI. So However, one of the investment we decided to lead is using AI into the blockchain. So it means that their product is like ChatGPT kind of interface. I assume that many of you interested in DeFi, but I assume many of you also don't know how to move the asset from Ethereum to Solana and going into some yield projects that Kelvin mentioned. But in this ChatGPT, you using ChatGPT kind of interface, I prompt like this: hey, I have 100 USDC on ETH wallet. Can you find the best yield strategy on Solana ecosystem? Can you just use the half of the money into park in that? And then they already beta product out, 10 seconds, all done. So I think it's real use cases. I think a lot of entrepreneurs, especially young entrepreneur with a strong confidence, they always want to making a complicated product. But always I prefer something easy to understand as an investor perspective. But again, a little bit ego on the entrepreneur. I'm not here to making some easy product. But at the end of the day, especially in AI space, I think ChatGPT is already advanced this AI space well beyond enough for us to utilize it. So rather than creating some new AI infrastructure, I want enterprise entrepreneurs who use that AI, the models, AI kind of a service already out there to make the crypto the more usable, adoptable for actually bring the mainstream adoption. So that's where I like of the AI integration of a blockchain.
So an elegant consumer AI product that integrates blockchain intelligently.
Yeah, but because that's also in line with a lot of Web2 conglomerates in Japan and Korea I met last week, they invest in so much on data center and AI stuff, but if they don't have application, that's something that actually very high-profile chairman of conglomerates are worried about. They invest so much in infra, but if there's no application, I think it's just a little bit of burst of that investment.
I see. Okay, rapid fire. Let's go down.
I think Sequoia called it the $600 billion problem, right?
Yeah.
And you may add a zero behind this $600 billion now. But I think Steve's point is really well aligned with mine in that when I look for entrepreneurs, I look for sort of purpose-driven, purpose-built type of solutions, right? Don't talk to me about being on-chain for the sake of being on-chain. Don't talk to me about AI just for the sake of AI. Talking about specific use cases, right? Similar to how people come and pitch PayPal, they get super excited talking about the solutions, but they don't spend a minute asking me what my problems are and how they can make my life easier, right? So focus on the problem set, then the technology should come, right? Figure out the optimal technology. And then I think the other thing is if we're also looking for the pick and shovels, right? So if you're building things within trust, within security, within guardrails, come talk to us.
Fantastic. Kelvin.
I'll keep it short. I'm still waiting for an awesome Web3 game to hit the market.
I agree.
Any of them yet? So,
thank you for that.
I think there's enough products in crypto that we know work, and I think the interesting part of where we are in the sort of the growth phase of crypto is we're sort of leaving that sandbox and approaching that mass market. So I don't think entrepreneurs need to be strictly focused on just finding the new thing that no one's ever thought of before. I actually think some of the biggest gains will be made over the next 5 years of doing existing products but just executing way better. And taking a product that's kind of done okay in the crypto sandbox but executing it at scale into the hundreds of millions of users as opposed to the hundreds of thousands of users. So I don't think entrepreneurs should be just looking around saying, I have to do something completely new no one's tried before. I think there's a great smorgasbord of options to do stuff that's already been proven has product market fit, but just execute and do it way better than it's been done before.
Wonderful. Thank you all so much for listening into this panel, and it's an honor speaking with you guys.